we'll look at the rebounding of indigenous banks' profits. And now, banks in Ghana will probably report higher earnings in 2019 after the country's regulator embarked on a cleanup of the industry and economic growth acceleration, according to Moody's Investors Service. Now, Ghana's central bank is seeking to bolster lenders by revoking the licenses of poorly governed companies and implementing stricter guidelines on capital buffers. Now, our discussion, which is centering on the rebounding of indigenous banks' profits, we're going to really look at this and what does this really mean. Now, in the studio, like I said at the beginning, is a man who is well versed in these areas. He's an expert, and I have in the studio Dr. Ebenezer M. Ashley, PhD, CEO, financial consultant. And Doc, good morning.
Good morning.
How are we?
By His grace.
Okay, all right. Doc,
yes.
Before we go into details of our discussion, can you not scratch the surface, but go into details and let us know what is the rebounding of indigenous bank profits? What are we talking about?
Thank you very much. First, I would say good morning to your cherished viewers. Actually, for some time now, little over a year, if you're looking at the fact that from August 2017, I would say till date, we've had some challenges in the financial subsector, specifically in the banking subsector. There have been situations where the banks some of them have been struggling to break even, let alone announce profit. And so what this statement basically means is that due to the turnaround in the banking subsector, the initiative of the Bank of Ghana, which has resulted in perhaps I would say the reintroduction of certain banks, this would help streamline the banking subsector, sieve perhaps the bad ones, not in terms of behavior but in terms of performance, and then make sure that the banks we have at the moment are those that are able to withstand the litmus test of financial and banking times. On the basis of this, we presume those in operation now might be operating at a level that is desirable, and therefore the recording or the incurring of losses would be a thing of the past. So rebounding means there have been some challenges in the banking subsector. There have been attempts to help remedy the situation. What is the current state of our banking subsector? Looking from behind and from within, you can tell that those that are left are those that are on course with regards to their operation, and therefore the times, the incidents of perhaps looking at the depositors, amount, recording deficit of about 4.1 billion in the case of some banks will be a thing of the past. That is basically what you are being told, and therefore it is the prelude, but it is a preamble as well. And this is to let viewers know that the panic withdrawal must humbly stop forthwith, because I'm going to mention figures to buttress the fact that the government has taken the initiative to remedy the situation in the banking subsector, so that whoever has a deposit will not lose even a peso, let alone a cedi of that deposit. And on the basis of this, there is no need for the panic withdrawal at this time. What we always have to look out for has to do with the behavior of the government through the Bank of Ghana. The behavior basically means what is the response, what is the reaction of the government to the action of the various banks. In this case, the action has been what universally is acceptable, and therefore we are on course as a nation. And on the basis of this, there is absolutely no cause for some financial alarm when it comes to the operations of the banking subsector. So the rebounding means, yes, we've gone through some challenges. We've emerged with some banks who are effective and efficient, and therefore the times when the deposits of customers would disappear or dissipate or would be outstanding would be a thing of the past. And therefore we are rewriting the losses to be profits.
So if we're rewriting those losses, and some banks have had to go, which have been consolidated, the remaining banks, this becomes like a check on you. It becomes like because that experience, you wouldn't want to experience it.
Absolutely,
Okay.
and that is the reason why we're talking about a rebounding here in terms of the phrase.
Okay.
And because if others have disappeared, if others have been consummated, they've been consolidated into one, and you still want to remain independent, then it means you must up your financial game so that you would get the opportunity to remain independent. If things are still a little bit dicey, then it will create room for some amount of consolidation or merger in this particular regard. So that is basically where we are now. And it is also refreshing to note that some of the banks, have taken the initiative to merge themselves up. And this
is that healthy?
Extremely. This is what some of us announced earlier. But instead of towing this line, some of the indigenous banks owners decided to rather seek refuge in the president by appealing to him to have the time extended. But given their financial situation, it will rather be more of a disaster to the nation, than remedy if you extend the time for the increasing of the minimum capital requirement. And so those who have realized that no, time is nigh, and perhaps the financial condition is still not favorable, have realized that they have to partner. As I've mentioned, it is a commonplace, and this wouldn't go through the normal, technical and difficulties. Why? Simply because the Bank of Ghana wants to ensure nothing but efficiency and effectiveness in the financial subsector. The opportunity has been given to the various banks to look out for their like terms. Where the like terms basically means look out for a bank that shares in your common vision and philosophy and be able to put your acts together. You only inform the Bank of Ghana about your merger, and the Bank of Ghana will bless it because that is what it is looking for.
Doug, it leads me to my next question where, indigenous banks have their individual operations. People, they have their various operations. Now, they want to merge, like you're saying. Therefore, are you going to look at those operations and all that? Now, based on this, can you tell us a typical process or a typical example of how these indigenous banks operate on a typical day or a typical month?
Thank you very much. The operational strategy might vary slightly from one bank to the other, but generally it is the same. And it is not even limited to the Ghanaian jurisdiction or setting, but extended to the international arena, except that the slight difference might be in relation to, one, the level of acceptability of banking operations in the country, two, the cultural disposition of the people, and then three, the environment in which you're operating. So these are the situations that may spell some little or slight differences. If not, it is general across board. Now, on a typical day, the usual banking would involve the acceptance of deposits, the withdrawals, where customers are in need of the loans. This would also be processed based on the due diligence of the bank, looking at the considering first the canons of good lending, and then going beyond to look at some financial statements, if possible, of the applicant as well. And so the basic operational needs do not vary. Now, if this question is in relation to the merger, the operations across board do not vary considerably. They may have the same deposits, and then the withdrawals accounts. Save, they may have different names for these accounts, but the underlying objective would be the same, and therefore it becomes a little bit easier. Now, with regards to the common vision and mission, here has to do with the fact that what does the bank seek to achieve? What is the expectation within the next 5 years, the next 10 years? So you look at the other partner and see if you're all treading on the same path of financial journey. If it is, then it becomes easier for you to put your acts together and be able to move on. Also, you also come to terms with how the eventual profits will be shared. And based on the percentage of contribution, what is the quantum of assets that Bank A is bringing on board? What is the quantum of assets that Bank B is bringing on board? Is it the same in terms of strength? If one, tilts the other, then we will determine the percentage distribution. This could inform the sharing of profit at the end of the day. And so these are some of the basics that the various banks would have to come to terms with. If they agree, then it becomes easier for the merger to take place. So for the typical operational performance of the banks, it does not vary considerably. I don't want this. We'll come to that and look at the management aspect, which is the order of the day. And in some cases, this also gives Bank A, I'm just being hypothetical, it may give Bank A, an edge over Bank B, because if Bank A comes in with strong operational management strategy, then obviously it will speak volume of the value of Bank A's total assets relative to Bank B. And this, from this angle, Bank A can argue and negotiate for some amount of edge in terms of the ownership and then eventual distribution of profit.
Now, we're looking at the rebounding of indigenous bank profits.
Yeah.
What are some of the key factors one would look at when it comes to this? Are there key factors to look at?
Yes, basically it has to do with performance, the overall performance. And in this particular regard, you look at the very key factor which has to do with the operational risk management. There have been instances where banks have focused essentially on their investment strategy to the neglect of the operational risk management. Benignly, an effective operational risk management would make it easier for you to record a successful investment. And so the operational risk management of the bank helps to be very diligent with regards to the approval of loans, and then making sure that those loans...
Who defines the operational risk management for them? Themselves or the regulator?
The regulator has a general regulation and then laws in place, which have been enacted by the Parliament of Ghana for implementation. And then out of the general laws, general rules, general regulations, you have to identify specific strategies that would inure to the financial benefit of your bank. So there is a general rule. It's just like having a constitution and then bylaws. So the operational risk management is the preserve of the bank. Who are the target markets? What are the niches of the bank? Who are the people involved? How strong are they financially to respond to our demands? This inform the operational risk management decisions of the bank. And on the basis of this, and since banks will be operating in different geographic settings and will be interacting with different customers, it will be difficult for the regulator to be specific with regards to how to operate. You see, so
because it varies.
Exactly. And since you are into business with profit motive, you do not necessarily require the regulator to tell you how to turn things around on the ground. So the operational risk management strategy is the preserve of the bank itself.
Is going deeper into that, is the operational risk management, is it segmented? Because if that bank is dealing with a different kind of people, I mean of course there's some class of people, Absolutely. Is that segmented?
You see, operational risk management to a very large extent employs the marketing strategy, where it responds to your question. Where the marketing strategy basically means, as a bank, you will not have the same level-headed customers across board. You have, I would say, structured or still stratified customers, where some will be very affluent, some will be somewhat affluent, others will be less affluent. So how do you relate to these categories of customers? So yes, the operational risk management will not be the same across board, because when it comes to the lending decision, you look at the type of borrower who has the strong wherewithal to pay back, and therefore the conditions will be less. But the other borrower whose financial standing might be questionable or challenging will require additional initiative in terms of the risk management scale to approve of the loan. And in some cases, the entire amount might even not be approved, for the benefit of hindsight.
Yeah.
So, as you said, it is true. It varies across board. And once again, the marketing strategy comes into play here, because you must know your customer and then determine effectively how to relate to the customer, not to drive the customer away, but make sure the relationship between the two of you remains healthy. So that is very true.
So, Doc, apart from the operational risk management, which is a key factor, I think there are lesser factors to look at, or we should just zoom on this one.
No. Is it the operational risk management? Besides this, to tie into this, the governance scale of the bank also is very important. The governance nature of the bank speaks volume of how the operational risk management becomes effective. Because when it comes to operational risk management, you're looking invariably at the day-to-day operations of the bank, and which also extends to include perhaps making decisions on lending to your borrowers. Now, who are the key actors with regards to the borrowing? How are they related to the bank? How, in terms of customers, in terms of ownership? And so on the basis of this, you will be able to make a strong and informed judgment with regards to the lending. So yes, the governance style of the bank speaks volume when it comes to the success of the bank. So we have the governance, and then the operational risk management, which actually would spell out an effective investment decision. So these are some of the things.
All right. Okay, Doc, we'll take a little break here, and then we'll be right back.
Okay.
University. Bernard, good morning.
Good morning.
You're welcome.
Thank you.
All right. Yes, Doc.
Yes.
Now, just wrap up on what you're saying, and then I come to Bernard.
Yes, so you were looking at other factors in addition to the operational risk. I've talked about the governance style, which is very, very important. And also, in some cases, the benchmarks, actually the corporate benchmarks, must be preceded by due diligence and appropriate analysis. If you look at the recent survey that was released by one of these HR companies, it revealed that there are some workers in the banking subsector who are contemplating on leaving because they believe the targets set by their superiors are unrealistic. So the setting of benchmarks must be preceded by due diligence and appropriate analysis. The fact that Bank B perhaps is treading on this particular journey does not mean Bank A should necessarily jump into it without assessing your internal mechanisms. For internal mechanisms, basically referring to your personnel. You may have people who are into the banking, who are into operations, but their level of skill, dexterity, and acumen might not match up to your opponent, and therefore the targets you set should be realistic. It should commensurate with the level of expertise of your staff. But there are some instances where some leaders engage in what I call the psychological targets setting or psychological benchmarking. What it basically means is that the person might be looking for about 50 returns, but would intentionally say, I need 100 from you, just to ensure that at least at the end of the day, the 50 will come. Because if it is 100, you may strive to get 60 to 70. But if the 50 is mentioned to you, you may end up with about 30 or 40. So the psychological benchmarking also exists in the management cycle, where it is overstated, so that at the end of the day, you'll be able to get exactly what you want or slightly more than what you're looking for.
All right, so let me come to you, Brenna. Now, Doc has taken us through what the rebounding of Indigenous bank profits are. We'll look at some of the key factors that one would identify and all that. Now, let me ask you this. This has to do with non-performing loans. Okay, now it says that findings show that non-performing loans are likely to improve the wake of tougher directives implemented by the regulator. Now, stronger economic growth and adoption of technology by the lender should be the best practice. Are there any other options?
Yeah.
you realize that non-performing loans is a problem for the banking sector actually, and looking at whatever the restructuring.
But why is it a problem?
It's a problem because it puts the banks at a risk.
Okay.
In a situation where people come for loans, and those loans at the end of the year are declared as bad debts.
Okay.
Obviously, it represents some kind of decline in the growth of the bank. Now, I believe that the issue of non-performing loans, should be really structured in a way that we can reduce, the level of non-performing loans in the banking sector.
Okay.
I think that some of these causes, I mean, when you read the literature and then you look at some of the things that have happened, in certain parts of the world, you realize that some of these things sometimes is a deliberate action, condoning, conniving with some people, and at the end of the day, you realize that these things are written off, and it affects the bank, and the money gets into some people's pockets, which probably is not helping. So I believe that, like Doc was saying, issues of governance should be looked at again, within the banking sector, and that is why I welcome this whole idea of restructuring the bank and then the issues of rebonding.
So Bernard, would you say that writing of loans of lenders is another good option?
I wouldn't say 100% that it is a good option.
Okay.
In a situation where there are genuine concerns, when it is written off, it is good. But when you realize that there are some kind of fishy deals around it, then I wouldn't describe it as very good or good.
Oh, okay. You want to add to that?
Yes. He has spoken at length. The non-performing loans, why would it even come up in the first place? If you look at the Ghanaian situation, where we had about the amount increasing from about 6 to 8 billion at the beginning of this year, you could trace this to as recent as 2014, when we began to have the power crisis, which affected the performances of many industries, many factories in the country. And you realize these factories might have contracted loans from the banks for their operations. Unfortunately, they are unable to engage in stable and continuous operation. And this made it difficult for them to pay back the loan. Not only the companies, you realize some employees benchmarked or collateralized their earnings to contract loans from the banks with the expectation that they will continuously remain on the job and be able to pay back. But because their factories were not functioning, they were also not being paid. And therefore, while the banks were finding it difficult to rake in monies from the companies, it was equally challenging for them to get monies back from employees who were expecting to be paid to also pay back their loans. So I'm just bringing in to buttress his claim that if the loans are genuinely, defaulted, then they could be written off. Because some of these are practical, but where there are some amount of management maneuvering.
So if it's written off, who loses? The banks?
The banks especially. That is what it means. But in some cases, or in most cases, if the banks are able to re-strategize, you realize the writing off of loans might affect the banks in the immediate term. But in the medium and long term, they even get more than that. Because writing off means it will affect their profit in the immediate term. But because they are re-strategizing and making sure that loans will be contracted to people who could pay in the near future, and because the government is also playing a part, and that is ensuring that the necessary ingredients required by the various companies to operate effectively are in place, i.e. Regular supply of electricity, availability of raw materials, availability of good roads to ease access to and from the workplaces, you realize the factories will be able to operate effectively, and loans contracted by the banks going forward will be paid for effectively. So within the medium and long term,
it's okay.
It is the whatever has been written off will be recouped in manifold. So it is not out of place for us from time to time to hear of loans being written off. If you look at the 5 consolidated banks, what is the government doing through the Consolidated Bank Ghana Limited? It is to review some of the loans, and if the need be, write off some of the loans. Those that are still being sought after are the huge sums that have perhaps been taken by the owners of the banks. But then you look at some individual customers, and the amount will be written off because it will not be economically beneficial to be chasing after those funds.
Okay.
You know, so this is what I had.
Ben, I want to add something.
Yes, I wanted
quickly,
to make a point. You know, I believe that writing off non-performing loans, you know, whether it is in the short term or it has a medium term or long term effect, I believe that the restructuring of the loan itself will be an important thing to do.
Okay.
For instance, if I come for a loan from you per se, and I'm not in the capacity to pay, you know, but I tell you that, okay, I am able to pay within this period. So why don't you assist me, build my business up, and then, you know, we have an agreement as to how the terms will be paid. So the restructuring can be done, you know, to some extent. Not necessarily.
Has that strategy been done before?
Yes.
It has?
Yes, it has.
Okay.
And I believe that going forward, as you move within the environment becomes a bit complicated.
Okay.
But we need to also adjust and then bring out innovative means, you know, to also look at some of these things. You know, if someone owes me and the person comes and say that, just write it off. I mean, you put me at a disadvantaged position. So how can I help another person another time?
That's it.
You understand? So we can sit down with the customer, whether it is industry. Doc cited the issues of electricity. After the electricity crisis, what were some of the agreements or the arrangements between banks and industries to sort of restructure their loans and then get them to pay? You know?
Before you come in, Doc, we're having a very interesting discussion here, and you would want to be part of this. You want to ask some questions. Doc is here, Bernard is here. Ask them questions or any suggestions you have. So you can call into 0302 786 571, 0302 786 571. Let me take for the last time, 0302 786 571. So call in, ask them the questions, any suggestions you have. We're waiting for your call. Yes, Doc.
Yes, I want to explain the restructuring, the word he used before someone even calls to ask about it. If you say restructuring, basically what it means is that the person is indebted to you. The amount he or she or it is unable to pay, where it represents a company. And what it means is that you have to review the amount and then see how best you can bring down the total amount within an acceptable means and to an acceptable level, so that there will be a incarnation, let me put it that way, or re-engineering of the interest between the two parties, so that the payment part will be rosy for the two of you. So restructuring basically means you review the entire amount. In some cases, the principal itself might not be significant, but it is the accumulation of interest charges that would blow the amount out of proportion. You know, so I've had the instance where we've led a customer in this regard, where the bank had to realistically look at the charges you have added to it, and therefore it was necessary to bring down the total charges. In some cases, not only the interest charges, but then the penalties for defaulting payments. You know, so if you restructure the loan to an acceptable level, you will be able to at least get some amount of money, rather than lose the entire amount. So restructuring helps the banks to at least recoup part of the funds that have been lent.
Doc, let me ask you this.
Yes.
On the restructuring, is it that you would restructure when somebody has come for a loan, or the bank itself, that Indigenous bank, would have to restructure its loan policies? How does it play? Because does it happen only when I have come for a loan, or it should be a laid down policy of the bank that, look,